We're facing a serious problem that nobody's really talking about. Another U.S. credit downgrade is likely on the way, and when it happens, it's going to hit regular Americans the hardest. Now, here's what shocked me when I started researching this. Our country doesn't even have a perfect credit score anymore. Every single major rating agency has already knocked us down a peg, and they're getting ready to do it again. So what does that actually mean for your bank account, your mortgage, your future? That's exactly what we're diving into today, and I promise to break it down in a way that actually makes sense. I'm here at Retirees Benefits because I've been in those shoes. I've lived paycheck to paycheck. I've had to choose between paying bills and buying groceries. And I know what it feels like when economic news sounds like it's written in another language. So today we're going to cut through the jargon and get to what really matters. Okay, let's start with the basics. The three largest credit rating agencies are S&P, Moody's, and Fitch. They rate countries just like your credit score rates you. AAA is the highest score, investment grade of the highest quality. A country gets a AAA rating by demonstrating their ability to meet their financial commitments. Here's the uncomfortable truth. The United States doesn't have a AAA credit rating anymore. S&P downgraded America's AAA rating back in 2011. Their reasons? A lack of credible long-term plan to reduce debt and the last-minute debt ceiling crisis. Then in August 2023, Fitch downgraded America's AAA rating too. They cited lack of cooperation between political parties, irresponsible fiscal policymaking, and reduced ability to manage long-term financial challenges. And then in November 2023, Moody's became the third agency to downgrade us, all three. Their reasons were that Washington is too divided to manage the country responsibly, the ongoing debt ceiling crises that keep pushing us close to defaulting, and exploding debts and deficits. Think of it like this. If your credit score drops, you pay higher interest rates on everything. When the country's credit rating drops, the same thing happens, just on a much bigger scale. And here's why it matters. When a country loses its AAA rating, it raises borrowing costs for the government, which increases interest rates for everyone. Most interest rates are pegged to or affected by interest rates for treasuries. It also reduces trust in U.S. governance and weakens the U.S.'s position as the world's financial anchor. Let me show you something that's going to blow your mind. I want you to understand how the politicians are basically destroying the country with fiscal irresponsibility. The United States government is in a lot of debt, but it's not just about how much we owe. It's about how much we're paying in interest on that debt. Look at this progression. In fiscal year 2020, the government paid $345 billion in interest. In 2021, it was $352 billion. In 2022, it jumped to $476 billion. In 2023, we paid $659 billion in interest. In 2024, it shot up to $881 billion. And in fiscal year 2025, we're looking at $970 billion in interest payments. Think about that. The U.S. collected about $5 trillion in total revenue, and we're spending nearly $1 trillion, about 20% of everything we collect, just on interest payments. Not on roads, not on schools, not on healthcare, just interest. And you can see how rapidly it's growing. It's completely out of control. And here's the big number. According to the U.S. Treasury's website, the government's national debt now stands at just under $38.4 trillion. The way we're going to surpass $40 trillion next year. Here's a question most people don't ask. Who's going to repay that $38.4 trillion? It's the federal government's obligation, right? But where is the money going to come from? Let me explain how this works with a simple example. Let's pretend the U.S. government has no debts and no surplus, just a clean slate starting from zero. Now let's say the government wants to go to war, maybe with China, or Russia, or Iran, or it could be a proxy war. And let's say the government needs $2 trillion to fund that war. So they issue treasury bonds, like IOUs, and they get $2 trillion from whoever buys those bonds. But who's going to pay that $2 trillion back? The government's main form of revenue is taxes. So the U.S. government is going to have to tax the citizens $2 trillion to pay that money back. They're putting the liability on us, we the people. This is our money, and they're being bad stewards of it. That $38.4 trillion the U.S. government owes is a financial liability they've created for you and me and future generations. That's why people say this debt is a burden for our children and grandchildren. And look, when I think about this personally, I don't know about you, but I'm not paying that money back. I pay taxes, I pay my fair share. But that $38.4 trillion, that's not on me. Good luck with that one. Let's talk about why another downgrade is basically inevitable. The rating agencies don't just look at debt levels. They look at behavior, patterns, and whether the government is capable of acting responsibly. And right now, America's showing all the red flags. First, we have rising deficits every single year. We don't balance the budget, we don't even pretend to anymore. It's just expected at this point. Second, exploding interest costs. Interest is now one of the largest expenses in the entire federal budget, as you just saw. Third, political dysfunction. It doesn't matter if you're Republican, Democrat, or Independent. You see it for yourself. Congress is more divided than ever. They can't even agree on basic funding. We just had one of the longest government shutdowns ever. Fourth, there's no long-term plan for Social Security and Medicare. The Social Security system is on track to go insolvent in 8 years, and nobody's doing anything about it. Fifth, debt is growing faster than the economy. This is the single biggest predictor of a sovereign debt crisis, and it's happening right now. If the United States gets downgraded again, the consequences could be severe. Mortgage interest rates could jump up. Car loans would get more expensive. Business borrowing would slow down. Stock market volatility would increase. Treasury auctions could start failing. Foreign buyers could reduce their purchases even more. And here's the scary part. The Federal Reserve might have to step in as a last resort, which means more money printing. And if they start printing money, that leads to higher inflation, weaker purchasing power, a weaker dollar, and more financial inequality. It's a vicious cycle. Unfortunately, it's not just Wall Street investors or big corporations who feel this. It's everyday people like us. If you're living paycheck to paycheck, even a small increase in your monthly payments can be the difference between making it work and falling behind. Young people trying to buy their first home? This makes it harder. Families trying to refinance debt? This makes it more expensive. Small business owners trying to grow? This makes loans harder to get and more costly. The most important question is, can the U.S. fix this? Is the situation salvageable? Here's the tough truth. There are only 3 ways to fix this. The first way is to cut spending. But I see this as politically impossible. Nobody in Washington wants to cut anything because politicians risk losing votes. Every time they try to cut something, it becomes a political attack ad. You saw what happened with recent cost-cutting efforts. They promised $2 trillion in cuts, and it turned into a flop. The second solution is to increase taxes. This is deeply unpopular. And here's some context on how bad our situation is. Even if you confiscated every single penny from the top 100 richest Americans, Elon Musk, Jeff Bezos, Mark Zuckerberg, all of them, that would be about $3 trillion. We're at $38.4 trillion in debt and rising $2 trillion every single year. So even something that extreme wouldn't move the needle. The third solution is to print money. Honestly, this is looking like the most likely outcome. It's the easiest, fastest, and least painful politically. But it comes with consequences. More inflation, more wealth inequality, and in the long run, it erodes trust in the U.S. dollar itself. Now, let me give you some perspective and some good news. First, America is not going bankrupt tomorrow. The U.S. dollar is still the world's primary reserve currency. U.S. Treasury bonds are still considered among the safest investments globally. Second, if you're asking when this downgrade might happen, my expectation is later in 2026 or 2027. We have some time. There are 3 major rating agencies, and who knows which one will be the first to pull the trigger. Third, best case scenario, if there is a downgrade, it could be relatively minor in its immediate impact. We survived the previous downgrades. The economy continued to function. Fourth, The fact that you're watching this video means you're preparing and educating yourself. You're not going to be caught off guard. You're already ahead of the curve. Let me give you some practical action steps. Number 1. If you have high-interest debt, especially variable rate debt, now is the time to look at your options. Can you consolidate? Can you refinance to a fixed rate before rates potentially rise? Can you transfer balances to a lower rate card? Number 2. Build your emergency fund. I know that's easier said than done when money is tight, but even putting aside $10 or $20 a week adds up. When economic uncertainty hits, having a cushion makes all the difference. Number 3. Review your budget and look for expenses you can trim. I'm talking about finding the subscriptions you don't use, the fees you can avoid, the small leaks in your budget that add up. Number 4. If you're planning any major purchases or loans, talk to your lender sooner rather than later. Get pre-approved, lock in rates where you can, and don't put off decisions that could cost you more later. Number 5. Invest in yourself. In uncertain times, your skills and your ability to earn money are your most valuable assets. Look for free training, education programs, or ways to increase your value in the job market. Look, I'm not going to sugarcoat it. The direction we're heading is not good. The trend is clearly bad, and the rating agencies see the same thing we see: debt exploding, interest costs exploding, political dysfunction increasing, and no plan to fix any of this. Another downgrade isn't just possible, it's probable. And when it happens, Washington's going to blame everybody but themselves. But the truth is simple. They caused it, they let it happen, and the American people are going to pay the price. But here's what I want you to remember. The people who do best in tough times are the ones who stay informed, stay calm, and take action. You're already doing the first part by watching this video. You're educating yourself and staying ahead of the news. That matters more than you might think. We've been through economic challenges before, and we'll get through this one too. The key is preparation, not panic. If this video helped you understand what's happening and what you can do about it, please hit that subscribe button and turn on notifications. We're putting out content every week to help you navigate exactly these kinds of situations. Drop a comment below and let me know. Are you worried about a credit downgrade, or do you have questions I didn't answer? I look forward to hearing from you. And check out our other videos on building emergency funds, managing debt, and finding assistance programs. All the resources we talk about are linked in the description below. You've got this. We're all in this together, and together we're going to figure it out. Thank you for the support, and I wish you a very nice day. I'll see you in the next video.